A very warm welcome to all my viewers today. And as you know, I've been bringing a lot of my guests here who are interesting individuals, and I bring onto the show people who are ace. And by ace, I mean people who are achieving creative excellence in their field of work. And the last few sessions, we have had a very interesting personality. I'm sure you all know Ashwini. She's been on my show earlier and had shared amazing uh, tidbits and guidance on stocks and how to trade and other information. And I'm very happy to have her back on this show today. And she's got something very interesting lined up for us today, and it is all related to what type of assets are available for investment, what are the risks involved in these assets, and the most important thing, a lot of people you might have heard about talking is the power of compounding. And I'm sure many people who are investors know that power of compounding is the most powerful uh, source of exponentially growing your investments. And today, Ashwini is going to be sharing some very interesting insights on these three aspects of the stock market. So, thank you very much, Ashwini, for being here today. And it's really amazing. The last session was so interesting, and I'm really happy to be with you again today. And I'm sure this is going to be an awesome session for our viewers. And over to you, Ashwini.
Thank you, Rizwan. Absolutely. I think it's been a great partnership with you. So always very happy to kind of, come on board and kind of, share whatever little experience that I've been gathering by profession and, over the years now. So very happy. And like you mentioned, a lot of people would want to invest and, start investing in how and when and what am I supposed to kind of, start off with. And these are not questions that only millennials are asking. These are questions that I think, even, working professionals who've been in their job for, 3 years, 5 years are kind of coming up with the same set of questions. So I thought that addressing these questions would be prime, and giving them a brief about these assets could be great. So without wasting any time, I will quickly share my screen and then we could just start off. So I think, okay, let's get on to the session of, let's start investing and make some good money so that we could afford a nice holiday when things are back to normal.
Money always interests me, no doubt about it. So bring it on. What's it that's going to help me make a lot of money?
Oh, definitely, definitely. So going ahead with kind of, the very first, what do you say? The entire concept of money, and, people keep asking me that, what is that entire thing? How much do I save? When do I begin? And, how do I go about, getting this entire idea? So this is like the 50-30-20 rule, which is kind of, globally followed, like those global standards that, out of the 100 rupees that you're making, 50 has to go in your needs, which is like, your recurring expenses, if I'm talking about, your home loans, your insurance, your payments. If you're in a city like Mumbai, commute is, earlier was one of the
So this is what you're
expense.
talking about, your monthly salary or whatever is
Yes,
your
yes.
income on a monthly basis, how to break it down intelligently, basically,
Yeah, so
right?
this is the usual setup. Like, there are people, who might end up saving an entire 50%.
Okay.
The idea here is that, in an ideal scenario, in a scenario where you have responsibilities to take in care, you have financial obligations, how do you want to kind of, go ahead with it? Like, if you could very clearly see it here, it's been distributed into needs and wants. So your wants are the Netflixes of the world, and, the Shopper Stop of the world, and, and the fossils of the
The
world
new
that you would want to
mobile.
wear. So and the new mobile. So of course, so these are of course your needs and wants. Needs, of course, these are those unavoidable, expenses, and then comes your savings. So
Can I
uh,
ask you one thing here? When you say need and want, there is also something what we can say prioritize it into what is the most important and try to avoid unnecessary expenses. Would that be a good idea? Because as an investor, you need to be intelligent in your decisions. Am I right?
See, again, it's a very personal choice. Like for
Okay, yeah.
me, buying my fitness band is probably the utmost priority.
Yes.
Like
Yeah.
I would want to kind of,
It's a
have my
very
fitness band.
personal thing,
It's a
basically,
very
right?
personal thing.
Exactly.
But for you, probably, on the contrary, buying books is, more important.
Yeah.
Whereas for somebody else,
So it's not fair to judge anyone based on his
you cannot
his
prioritize.
needs
You
and
cannot.
wants. Basically, it's all
And
very personal. Yeah.
yeah, and probably in terms of, like I was mentioning, that when you talk about your needs, when you talk about insurances, these are fixed things. Okay, your premium is going to definitely different from my premium and someone else's premium, but these are expenses. If you are,
These
if you're
are
having
fixed
a home,
fixed cost, you
these
could
are
say,
fixed
right?
costs. You
Okay.
take a home loan, you are supposed to pay the EMI,
Yeah.
or you're supposed to pay your maintenance, your electricity bills. So these doesn't come with a compromise that
Unavoidable.
what, yeah, these are not unavoidable. That what, I'm not going to turn on the AC this entire 3 months. It's not happening. And
Right.
but there is an option that can I probably renew my Netflix or not choose to renew my Netflix and kind of be with an
Doordarshan.
Amazon Prime or yeah, or some,
Doordarshan.
or a Doordarshan for that matter. So it's, I think it's very personal. So like, and that's the reason I told a very ideal scenario that you don't have to, like, really regret that, what, I did not live my life, I did not eat my favorite
Yeah.
ice cream, I did not go to the movie that I wanted to go to. But then the point is that a lot of people forget the fact that you have to start saving. And
Exactly.
there's a very clear difference about savings and investments. When you talk about saving, this money is going to keep lying in your savings account. And, like, if you see on the other side of the PPT, it's about how early that you start saving. So if you probably are saving at the age of 25, you can save as low as 15%, because you know that your income is going to grow. You have a long way ahead. You probably do not have so many obligations, so the number of years that are available for you to start compounding is much much higher. So you can save a lesser percentage. Whereas if you start at 35, it's going to be as high as 23%. Why? Is because you've lost 10 years, which the money could have compounded.
And
Now
then
that,
you've got added responsibilities, commitments, and there are many other things that are adding on to your
yeah, because
fixed cost,
you
basically.
need to make a certain corpus, right, when you retire. Or if you're planning for your 50s and 60s, there are certain medical requirements that need to be fulfilled. There are certain survival needs that need to be fulfilled, so there is a certain corpus that's needed.
So you
uh,
would advise them to start early, as young as college students, basically. Am I right? So where he basically develops and builds his discipline of saving and investing. Am I right?
See, when you start early, it's always like, even if it is your morning course, when you start early, you have a longer day to kind of, you
Yeah.
feel more energized. When you wake up at 6 a.m. versus when you wake up at 8 a.m. versus you wake up at 10 a.m., there is
Right.
a difference. The energies are different. So, of course, when you start early, probably when you're starting at 21, 22, that kind of an age, it becomes a lifestyle. It becomes a part of your life.
Absolutely.
It becomes very unconsciously that this is something that you start doing, versus when you start off at 30, 35, where the pattern is set, where you'll have to probably cut throat upon a lot of needs that you were doing, not go to your favorite club, not go to your favorite movies, not wear the brands that you want. And that, I think, accommodating those things become a little challenging.
Right.
So yeah, to, I think, avoid that, to just kind of build up a discipline. But again, it's in the will and wish of the person. It's on the will and wish of the individual.
But as an investor, you think that's a good idea to develop these skills in your kids? If for a person like me, I've got teenagers, so for me to advise them to start early in investing would be a good way to go. Am I right? So that they are more disciplined, because in our times it was not so hip to actually ask your kids to go into investing, right?
See, I think, when you talk about teenagers and when you talk about kids, I think they have the biggest source of income, which is called as pocket money. Okay, and it is non-taxable as well.
Right.
And they have something called as piggy banks, which don't give them,
No, not
any
that age.
different.
I'm talking about like a guy who's just graduated. He's in his first job and he's just started getting his monthly salary. So rather than going out, night clubbing, enjoying his weekends, he'd rather discipline, distribute his money, and to be more aware of how he can exponentially grow his
Certainly.
money.
I think, along with his offer letter, the minute he presents to you the offer letter, I think you'll have to start up, signing him for any, SIPs, at least one or two right away. You should really
Mm,
congratulate him that, what, I will start off with the first 500 and 1,000 rupees for you. And this is what I would want you, to kind of, do it. Now, this, of course, is, a matter of compulsion. When you start off with, 1,000, 2,000 kind of an amount, now this can not really hamper, but the entire idea is to start gradually increasing that 2,000 to 4,000 and 6,000, and then you are at a position that you're not getting away with the math, that you are investing 10 to 15% of whatever income that you're earning in that amount, or in that particular
Basically,
asset.
it's a very fundamental process of making a habit for him. So
It is
it
very much.
becomes a subconscious, or what do you call it, unconscious process for him in his whole life, basically, right?
It's a
Basic,
habit. It's a habit.
yeah,
Like,
yeah,
tipping, is in habit. Like, you are at a restaurant.
yes,
There is a certain percentage. I'm not recollecting what percentage, but there is a certain percentage of the bill that has to be the tip that is to be
right.
given, to the service provider. Now that's a matter of habit. You kind of like the service, you tip more. You do not like the service, but there are a standard that you're
Some
supposed to
standards,
kind of,
minimum
yeah,
standards, of course.
follow.
Yeah,
But
absolutely.
it becomes an all, and it becomes, I think, a more accepting factor, is because when the child starts early, and when the child wants to start, probably buy things, travel, invest in his own further studies, he feels or she feels more capable enough, in terms of planning their own finances, making decisions. And I think when wherever money is involved, you do kind of become more cautious, you pay attention, and then at some point in time, there is some reading, some news flashing here and there, like if you are invested into mutual funds, like or if you're invested into equities, any news flashing will you'll catch your eye, because you
Yeah,
have some portion of your money invested,
absolutely.
versus like when the kid is not managing, or when the early 20s, they are not managing their own money, they are going to be clueless about what will excite them more is sale up to 50% off. I think that will be more exciting to them, rather than okay, markets have tanked 500 points,
Right.
so they'll kind of
Because
figure out.
the focus is now on to investing because you've been aligned with that concept. So now anything you think and do, you are aligned with investing and stock market, what's going on, what's the economic scenario and opportunities and so on and so forth. So
See, I will
it's
just
something
quickly
very
address in the next slide. Now, when I talk about asset allocation, now, when I talk about stocks.
may I just ask you a question?
Yeah.
Because that has been behind my in my mind for a long time. You are quite young in your investment process now. So what has inspired you? We would love to know more about how you got into it and what is it that made you go into a disciplined investment, habit. What we'd love to know more about.
So I think two factors, of course, one being my father, because I learned it from him, and his way of kind of managing finances. Second, I ended up, I think, reading a lot of Robert Kiyosaki, and a lot of money related Napoleon Hills and Benjamin Grahams of the world. So I think that has been an impact.
Benjamin Graham is quite heavy.
Intelligent
For you to
investor.
read that is a real achievement, basically, right?
It is like a bible, it's
It is.
actually like these are things that are a lot of takeaways. Like, if I have to tell you, you like in Rich Dad and Poor Dad, and it is one of my favorite books, because it does talk about something as clear,
Four
distinguish
quadrants,
at,
yeah.
yeah, the cash flow quadrants and all of that. And so it talks about very clearly that what are your assets and liabilities, why is it that there is an important, why the rich gets richer and the poor gets poorer, and there is a certain psychology of money or there is a certain mannerism that I think money appreciates. So you'll see some people they think and have the digits of the salary, and then they have the luxurious of the life, and still they are into debt. Versus somebody who's not making that amount or not making that money, but is going on holidays, having a lifestyle that is decent enough, but a debt-free lifestyle. So I
Right.
think the entire agenda was to how do I have a secondary source of income? Because considering 2008, considering the pandemic that was recent there, we kind of are we kind of have an idea that what, even if you're an entrepreneur or you're salaried, you cannot survive on a primary source of income. So you need
Absolutely.
to have a secondary or a
And it's
tertiary
getting
source.
difficult by the day, isn't it? Like
It's getting difficult because your standard of the cost of living is increasing, your standard of living is also increasing. The inflation, of
inflation.
course, is going to kind of come in. So whatever 1,000 rupee could buy you 10 years ago, 1,000 rupee is nothing. You go
You
sit, dine, and
remember,
come.
Ashwini, in 35 years ago, one head of the family was actually able to handle the whole family. It was like a joint family, and one member who was able to take care of the whole family. And today,
Yes.
even each and every member of the family is working, but even then, they're not able to sustain, or what would say a comfortable lifestyle. Isn't it true to the sense right now?
See, again, if now this becomes very subjective. This, I would probably, pose a question that, okay, what is the city that you're living in? If you're talking about,
Uh-huh.
living in a city like Mumbai and Delhi, and, you're, I think, as a couple, if you're, struggling to get a property, which is going to not cost you anything less than 2 CR, kind of, an
Exactly.
average property, like a decent, 2 BHK or a 3 BHK. Versus, I think if you go down to any tier two, tier three kind of a city, like if I have to talk about Indore, if put the same amount, I may end up having a bungalow depending upon which
No,
location of
I'm just
Indore that
talking
I'm
about
taking.
metropolitan cities. Basically,
Yeah.
that's a general phenomenon because, as you remember, now everyone, even the husbands and wives, they're all earning. To make ends meet, and even then, the inflation and the cost of living is just going beyond the capabilities of. I'm a general statement that I'm taking. I'm not specifying any one particular uh,
And hence
idea, but
diversification and this
that's
entire.
where I think, yeah, you're right. You need to diversify and not depend totally on your job, but make sure that you have allocated other investment tools and products, basically, right?
So there cannot be just one source of income. There has to be a secondary or a tertiary source of income. That has to kind of come in, or a passive source of income. And see, there are, like I was mentioning, that there are
Yeah,
these certain.
I think you should go ahead with your presentation because that would be better for you to go ahead
Sure,
and
sure, sure.
present to them.
So
We
I
can talk
like
about
we were
managing.
talking about the asset allocation. Now stocks become just one of the things that we're talking about when it comes to asset allocation. There are things like metals. When people used to believe in buying white and yellow metal, or silver and gold. These were the ones that were kind of and how gold reacted to the entire pandemic was a very evident thing, that when everything when there is like a bear market, gold turns out to be like the cushion for a lot of these times or these cycles, if I have to say. So metals have played a lot of role. A lot of people believe in sitting a lot of cash. Now again, sitting on a lot of cash does not kind of help you. When I say cash, this is the cash availability in your savings account, which as of today can give you probably anywhere between 2.5% to 3.5%. Post taxation comes down even further, depending upon which bank you're kind of associated with. Again, you have your bonds, you have your government bonds, your corporate bonds, more like these debt instruments. Something like private equities that have kind of come into picture. Now, somebody like you and me, I don't know how comfortable it will be, start, go start invest into a startup company, shell out their 10, 15 lakhs or whatever the hard-earned savings that they have, and not really sure about if the idea is going to work out or not work out. So private equity again is it's restricted to the HNIs and the ultra HNIs. is because they have the risk appetite, to be very honest, and they kind of can take that kind of a risk, and they can diversify further. Real estate, I think, for us as Indians, have been the most vested upon kind of an asset. But again, unless and until it's the home that you're living in, can never be an asset. It's always a liability because it's not generating any income. Okay, if you're talking about a second home which is giving you
But
rentals,
people
which
still
can give
think
you.
that's an asset, isn't it? That's a misconception people hold basically, that my property, the home I'm living is worth so much. Okay, it's worth so much, but what are you going to do? You're going to live in the streets and sell off your house. So it's so unrealistic, isn't it? It's not an
But we
asset,
have,
basically.
if you go back to the Maslow's hierarchy theory, security, for humankind,
Yes.
is one of the core things. कि अगर प्यार नहीं हुआ तो भी ठीक है, security तो होना चाहिए, रोटी कपड़ा मकान. So you can't do anything without it.
But what you're saying, Ashwini, is real estate as a second home is an investment. Am I right?
Yes.
As your own home, it cannot be considered as an investment. Am I right?
Until and unless you kind of in a rare scenarios, setting up a PG system, like like
Yeah,
most of the
that's
people
yeah,
that they do, or you're kind of sharing apartments, or something
right.
like that. See, unless and until that setup isn't there, I'm talking about a very normal scenario that a family of four is living in that vicinity. um let's talk
It's not
about the cost.
generating any reoccurring
It's not.
income on a regular basis,
You're
basically.
supposed to take care of your bills,
On the
you're supposed to
contrary,
take care
you're
of
spending more, shelling out maintenance, electricity, blah 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 blah.
a lot of things. And I think real estate kind of comes in picture only uh, more to do, I think, with a second investment, wherein I've just bought it for X amount, I'm waiting it, I'm holding it for another, like 20, 30 kind of not 20 but at least 10 years, and then I'm wanting it to appreciate and then sell it off for another 2x value. Now that you usually don't do it for the house that you're staying in. Like, yes, there is a pattern that people progressively sell and buy houses and all, but then how many of them are comfortable doing so?
Right,
So I think
right.
that
So
ways.
let's continue on that. Yeah, we've got
And
10 minutes, huh? So we can continue
yeah,
after that.
very quickly, I will show you. So when you have so many options, it's always a confusion as to what is it that I should start investing into, and how do I kind of go about it? Do I hold money? Do I put it into my fixed deposit, or do what about it? So of course, to answer those questions, you have something called as a risk scale. Now, any investment advisor or any portfolio manager or any wealth advisor would actually assess your risk appetite to and then probably would suggest a product. Now this is an ideal way, and this is, I think, the industry standard way to even present something to you. So there is something called as a conservative person versus somebody called as a very aggressive kind of a person. So going by the literal meaning of somebody who's conservative is going to be somebody who does not appreciate capital erosion. So when I say capital erosion, he is okay his 100 rupees becoming 105, but he is not okay his 100 rupees becoming 95. So that is when I talk about capital erosion. Whereas now somebody who is very aggressive would say that, what, I can take the risk. I'm okay, wanting my, 100 rupees becoming 120 rupees or even 125 rupees, and I can take a hit till 80 rupees. So his risk appetite is like literally 4 times higher than, a conservative kind of a person. And when people like this come in now, the risk scale defines a lot of factors. It talks about how many people are dependent, what are the number of dependents on the earning member. Are you the primary earning member? What age bracket do you fall under? What is the pay scale that you're falling under? Are you into a seasonal kind of a job role, or uh, uh, basically a job role and all of those things, your skill set and job roles. So your risk appetite and your risk profile is kind of first defined, and probably based on that, you have this entire risk and return ratio that kind of tells. So just kind of confining to mutual funds. If you're somebody who is happy in investing into a small cap fund, okay, which is a very aggressive kind of a fund, and it is primarily invested into all the small cap kind of equities. So you are definitely on the higher risk and higher return kind of a ratio. But then, can I give this to a conservative person? Necessarily not. I can't give it to somebody, who's conservative. So, this is, you can see on the screen that, an ideal scenario or an ideal, distribution of, okay, for example, if it's a conservative person, he would want major of his income, like, somebody in their 60s and 65 does not want to play with equity at all. They would rather invest into fixed
Yeah,
income.
because high risk, it's very high risk.
Yeah, I mean, you have your rate of interest that is, higher for a senior citizen, 1-2% higher. Why will I kind of, go in for equity? So, probably their cash equivalents are going to be 5 to 15% just to understand their day-to-day, kind of requirements. And equity, they would still want to kind of, take an exposure, but it's going to be as low as 15 to 20%. Versus somebody who's very aggressive can go up till, 80 to 100% into equities. So this is, I'm not saying that this is like the cutthroat thing about allocation, but this is just to give you an idea that, based upon my risk appetite, my entire asset allocation can be very, very different.
Right.
And, this can also happen, like, probably your asset allocation could be very different from your wife's asset allocation because, you probably have got different priorities, if both of you are earning and, things like that. So just going further, like I promised that, I would tell you about the power of compounding. And so we take a very quick scenario here. 1 lakh rupee invested at a rate of 8% for 15 years. So this is the scenario that I am kind of, taking. So year one, now please understand when I talk about compounding, this is everything that is your mutual funds that are doing. When I'm talking about non-compounding, this is your savings account. So you remember when I talked about, what's the difference between saving and investing? So this is what the difference is between saving and investing. When I keep saving, like our mothers used to do, कि 500 का bundle बना के rice के डब्बे में डाल दिया. That's saving. That's one form of saving. But that's not going to grow. So your non-compounded are usually your cash that you hold. But when you talk about investing, this is how investing beautifully works. So 1 lakh rupees in the first year becomes the same amount, but you start seeing the difference. You see a 6,000 difference in the fifth year. In the 10th year, there is a notional difference, and at the end of the 15th
1
year,
lakh difference, yeah.
There's a humongous difference,
Yes.
and that is the primary reason. Even when you fill your mutual funds ka form, they'll tell you that for my first 12 months can I do a 1,000 investment? Okay, fine. For your next month, do you want to increase it by a certain percentage or do you want to increase it by a certain amount? 500 and multiples. So you can either increase it by 500 rupees every year or you can always increase it by 10 to I think 20% every year. I think the highly recommended thing to do is to start increasing your amount that you keep investing, because then this is again 1 lakh rupee that has been invested. So this amount, this 3 lakh odd, that is an exponentially bigger number because the amount that you keep investing grows much higher. So this is the beauty of when it comes to
But
compounding.
then again, you need to be very, very patient with your money and actually wanting to compound because many people are so, uncomfortable to spend that amount of time. They want instant returns. What can give me maximum profits and double my money and all that. And that gets them into the wrong kind of
Then I think they
product.
should I think, walk into, I think, every antique store and then, wish for a lamp कि उसको घिसो genie निकले and then you can double your this thing. There are no shortcuts to money unless and until you have not inherited that kind of a money or won a lottery ticket or money just come in. In a normal scenario, there are no shortcuts. Like this is I'm talking about normal working class people who build assets over a period of time.
Absolutely. Great. So, a lot of information that you've shared, asset management and compounding and so on. Uh, what I love about the whole presentation today is, Ashwini, you have given the audience a lot of info about what money can do if they put it in the right product
True.
And as they all know, I don't think many people know that, but they still seem to be very comfortable with their savings account. They say,
See,
okay, I've
again,
got that
I'll
amount
probably
money.
very quickly tell you this. Now they're comfortable with their savings account is because, the knowledge goes missing.
Exactly.
My friend told me to invest into this. My bankers told me to invest into this. Now, please understand that whatever presented on the screen was like, the permutation of combinations about, okay, these are the possibilities, but these are not hard bend rules. When you go out there, when you make your own investment decisions, it's solely upon you as an individual as to how you're going to take it up, and whom do you want to listen to. See, there are researchers that are available, there are papers that are available. It's on you to actually do your math and probably take one or two advices here and there. Like when we go to doctors, when you have to do a major surgery, you will kind of take a second